everyone, and welcome back to Lendy's monthly financial and property update. This month we're in February, so welcome to February. I hope you're all having a great start to your year. In today's video, we're going to discuss the current economic market with a focus on winding down of some of the government stimulus packages that we've seen over the last 12 months. With us today, we're welcoming back our CEO and co-founder, David Hyman. So welcome back, Dave.
Thanks, Sarah.
Let's just get right into it, as we always do. Why don't we start, Dave, with a bit of an overview from your point of view on how the economic market is doing today and anything that we should be thinking about in the coming month or so?
Yeah, great place to start. So obviously 2020 was a pretty crazy year for everyone on a number of fronts, and thankfully 2021 has started off relatively strong from an economic perspective. So we obviously came off the back of whether it's called the second wave towards the end of last year, the Avalon cluster as it were, where most of Sydney and the rest of Australia sort of renewed their lockdowns, and we've kind of come from that into 2021 with a renewed sense of optimism, and that's kind of flowed through into the economy. So we've obviously seen the economic recovery at a domestic perspective accelerate probably faster than a lot of the economists would have thought last year. So we're seeing sort of GDP numbers, the consumer sentiment numbers all starting to pick back up, and that's certainly happening, and it's, as we've seen globally, much faster than we sort of expected as sort of lockdown measures are lifted and economies kind of get into this new normal of I think it's sort of been referred to a couple of times as the hammer and the dance, and we're certainly playing that out in Australia. There's obviously been a bunch of fiscal policy elements that have fed into this. So we're seeing some of that play through around the responsible lending changes that are, the legislation's kind of up for debate at the moment. And as, consumption's recovered as well, we've seen that sort of flow through to the property market. So auction clearance rates, I guess, as an outcome, have been exceptionally high this for this time in the year. We're seeing auction clearance rates in the 80s on pretty reasonable stock numbers, which is great. There's certainly more buyers than sellers in the market though, and that's certainly keeping prices up and contributing to those high clearance rates. There are stories all over the country of places selling for well above reserve, or people that have been in the market for 6 months and just can't find a home to buy. So a lot of that stuff is fueling the economic recovery, which is great. And we've obviously got record low interest rates, which mean that for those of you who are either looking to buy or looking for an investment property, it's quite attractive to get into the market.
Couple of positive shoots, I guess, as we move into 2021 for anyone looking to get into the property market. You touched a little bit there on bank loan deferrals and starting to fall over the last few months, but I'm quite conscious that coming up in the not too distant future is the end of some of the government support schemes, and the one in particular would be JobKeeper. I know those payments are ending in March, and for a couple of groups of employees, that's going to be pretty difficult. But can you elaborate a little bit more on that winding back of that government support, and is it going to have a big impact on kind of the ability of homeowners to pay back loans?
Yeah, really good question. I think the place to start on all of this is clearly the government has shown their willingness to kind of put their hand in their pocket, so to speak, and prop up the economy if the COVID-induced downturn worsens. We obviously saw the extension of JobKeeper till March. It was initially slated to finish in September, based on things like the second wave in Melbourne and the economic numbers that kind of came out the back of last year. So I think as a starting point, everyone should sort of rest assured that the government's kind of got our back on this. Beyond that, though, we've seen some really positive shoots. So ultimately the purpose of things like JobKeeper are to create a floor underneath a falling economy or a falling job market. As we've seen businesses come back online, as lockdowns have been wound back, and businesses and individuals find their new normal, we've seen things like the unemployment rate drop. It was down to sort of 6 and a bit percent in December. Although that remains high, I remember the height of the pandemic, people were talking about 10, 15, 20%. So, I think in context, the underlying, we obviously spoke before about the underlying economic activity for some of those key metrics. If we, play that out to the job market as well, I think, based on what we're sort of seeing, I think the time is right. What I think everyone needs to remember, and obviously this kind of goes without saying, is the economy has a bunch of built-in safety nets. We have things like New Start. We have things, for people who lose their job. I think, JobKeeper was put in place, to ultimately prop up a large part of the economy that wasn't set up for this sort of thing. So as we look forward, subject to the economy continuing to perform as it is, we don't think there'll be a major impact on the market. And certainly, and we can talk a little bit about, for those that are impacted, what that actually means for your mortgage and how you might be able to speak to your bank.
Yeah, I think that's a really good point. So, for anyone who maybe is in some of those employment categories where, even though they're coming off JobKeeper, that employment category, so I'm thinking probably more of the travel sector, they're coming off JobKeeper, but their category is still impacted, and they might have in the back of their mind some concerns over repayment. What would you potentially kind of advise them to be thinking about when it comes to that kind of home loan piece?
Yeah, well, I mean, the travel industry is an interesting one to use as an example, and I won't spend too much time talking about this, but, there's obviously a lot more certainty than there was even sort of 6 months ago around the certain sectors that are going to recover and those that are going to take longer. And I think travel's clearly going to take some time to come back. So clearly, if you're in the travel sector or a sector hard hit by COVID, there's obviously a whole conversation around, do you reskill and do you move into another area of the economy? The job market is quite strong at the moment based on the numbers we talked about before. But if you do fall on hard times and you're concerned about JobKeeper not being extended, there has been some talk of the banks changing the way they deal with hardship as it relates to COVID. Now, what that means at a very, very high level is when COVID was rolling out, there was obviously tens or hundreds of thousands of customers impacted. And to obviously assess those quickly and make sure people didn't slip through the cracks, the banks opened up hardship or payment holidays, or they lowered the bar to hardship and payment holidays pretty significantly. What's happened recently is the banks have now started to tighten that up a bit. That doesn't mean they're not there and they're not available. It just means that they look at more on a case-by-case basis. So if you're in one of those sectors of the economy that's been hit, travel is a great example, and you haven't reskilled, found that next job, or worked out how you're going to obviously pay the bills and pay the mortgage, then reach out to your bank, have the conversation. The option of a payment holiday is not the only one to look at. I would really encourage people to take a step back. Obviously, you can speak to a home loan specialist, a financial advisor, or someone else skilled in the space to help you go through this process. But ultimately, you've also got the opportunity to look at things like perhaps interest only, or perhaps fixing your rates if it's uncertainty you're worried about before going into a payment holiday. Because these things do ultimately end up costing you money. It's not you're not putting your mortgage on pause, you're putting your payments on pause.
Thanks, Dave. That was really great advice. I know there's a lot of people who are definitely starting to think about what they're going to do if they come off that JobKeeper payments. But for everyone else out there, it has been nearly a year since that first big RBA cut last March, and we're going to be covering a lot of topics in regards to that in our March update. So do look out for that. A year on from potentially fixing your rate or moving to a variable, it's a good time to start thinking about a review. So we're going to cover those options in our March update, so look out for that. But in the meantime, Dave, as always, that was just such great advice, some really great insights. So thanks so much for joining us today.
No worries, great to be here.
As always, don't forget to subscribe by pressing the bell on the bottom of your screen. That way you'll get alerts every time these videos are updated and a new one is uploaded. Thanks again for joining us. Thanks again, Dave, and keep an eye out for our March update. It's going to be packed with useful information about those who want to do a rate review. Thanks again.